Hi, my name is Jamie Johnson. Welcome to my trading room and welcome to the art of trading the correction. Right off the bat, I'm going to give you the secret to the art of trading the correction. You want to learn how to enter at or near the end of a correction in order to get into a profitable position in the direction of the main trend. This is part one of a three-part series. This part focuses on trading ABC corrections. ABC corrections are ideal to trade because when and where they end is very predictable. ABC corrections are found in every market in every time frame. So without further ado, let's go ahead and get started. Section 1, the basics. Let's go ahead and look at what we're going to learn in Section 1 of Part 1 of this tutorial series. We're going to look at the different characteristics between trends and countertrends. Trends, also called impulse waves, usually unfold in non-overlapping patterns. Very often they unfold in five-wave patterns. One of the most important characteristics of trends are trends usually unfold in the direction of the main trend or in the direction of the trend of the higher degree. Countertrends, also called corrections, often unfold in multi-wave sideways overlapping patterns. And in the next couple of slides, I'm going to demonstrate the difference between overlapping patterns and non-overlapping patterns. Corrections often unfold in three-wave patterns. If they do unfold in three-wave patterns, they're called ABC corrections. If they unfold in multi-wave corrective patterns, they're called complex corrections. ABC corrections are the best corrections to trade because they very often complete in very predictable price and time targets. Non-overlapping wave patterns, characteristic of trends. Let me show you what I mean by non-overlapping waves. We have 4 rallies and 3 declines. The rallies represent trends and the declines represent corrections. They're corrections because they are counter direction of the main trend. And as you can see, the low of these two corrections do not trade into the range of the previous trend. They are non-overlapping waves, characteristic of trends. Let's now look at overlapping waves. We have 3 trends, 3 counter trends. You can see that the counter trends now trade into the range of the previous trend. This correction here trades into the range of this previous trend. This is an overlapping wave pattern characteristic of counter trends or corrections. Okay, with this gold daily chart, I'm going to demonstrate how trends usually unfold in non-overlapping wave patterns and counter trends usually unfold in overlapping or three-wave patterns. As you can see, gold was in a bull trend from the July low to the February high. And within this bull trend, there are smaller bull trends, 4 to be exact, shown in thick green lines. And as you can see, all these smaller bull trends unfold in the most part in non-overlapping wave patterns. As you can see also, the July 15th low to the August 12th rally unfolded in a nice 1, 2, 3, 4, 5 wave pattern. And the November 4th to December 12th rally also unfolded in a nice 1, 2, 3, 4, 5 wave pattern. Another thing to see in this gold example is that all these bull trends unfold in the direction of the main bull trend. As you can recall, when I listed the characteristics of trends and countertrends, one of the most important characteristics for trends are trends usually unfold in the direction of the main trend. Let's now look at the counter trends or corrections in this gold example. There are 3 of them, and they're shown with thick red lines. As you can see, all 3 of them unfolded in nice ABC corrective patterns. Now, could you see how advantageous, how profitable it could be to learn how to enter a trade following one of these ABC corrections and getting into a position in the direction of the main trend? Let's look at the overall pattern now from the July 15th low to the February 2nd high. We established earlier that it is bullish in fact, but it doesn't have characteristics of a trend. It does have 1, 2, 3, 4, 5, 6, 7 waves, so it's not an ideal 5-wave pattern, but as you can see that it is a non-overlapping pattern. The counter trends or corrections do not trade into the range of the previous trends. This is characteristic of a trend, signaling that the July 15th low to February 2nd high is a bull trend, and the higher degree trend most likely is bullish also. We're going to look later in this tutorial in detail each one of these bull trends followed by a corrective decline. But for now, let's go ahead and look at some other examples to demonstrate characteristics of trends and counter trends and the important information it gives us. Okay, this example is Intel, INTC. It's a stock and this is daily data. Let's look at the range from the September 28th low to the November 18th high. Whenever you look at a trading range, you have to ask this question to yourself. Does this range have more characteristics of a trend, more impulsive characteristics, or more characteristics of a counter trend, more corrective characteristics? The range from the September 28th low to the November 18th high is not an ideal impulsive pattern, but it has more impulsive characteristics than corrective characteristics. Let's now look at the decline off the November 18th high. By no means do we have an ideal ABC corrective decline, but we have an overlapping wave pattern. It's a complex correction. So let's talk about how basic yet very powerful this information is. We have a trading range from the September 28th low to the November 18th high that has impulsive characteristics, characteristics of a trend, and the decline off the November 18th high has corrective characteristics. As mentioned before, one of the important characteristics of a trend are trends usually unfold in the direction of the main trend. So if we have a bullish trend up, followed by a corrective decline down, more than likely the direction of the higher degree trend is also bullish, which means that this November 18th high has a higher probability to be taken out before the September 28th low is taken out. So traders that are trading Intel in this time frame know what direction or what side of the market they should be on. Let's go ahead and see what happens. And there we have it. November 18th high was taken out as anticipated. Before moving on to another example, let's focus in on one more thing. Let's look at this January 24th low to February 15th rally. Impulsive characteristics, for the most part non-overlapping waves, followed by an ABC corrective decline. The point I'm trying to get across here is we had another bullish rally, bullish trend in the direction of the main trend, and a corrective decline. So if this higher degree trend is bullish, more than likely impulsive waves will unfold up and corrective declines will unfold down. Can you see how powerful yet basic but powerful this information is? Let's go ahead and go to another example. Okay, this is S&P E-mini 15-minute data. Let's go ahead and look at the trading range from the January 19th high down to the January 20th low. It has a non-overlapping wave pattern characteristic of a trend. The rally off the January 20th low has a corrective pattern. What this basic information tells us is that the trend of the higher degree most likely is down because of this impulsive pattern down, and the January 20th low should be taken out before the January 19th high is taken out. We also have a potential A, B, C corrective rally complete. Let's go ahead and add some bars and see what happens. Well, the wave C high was taken out, signaling that this is not an ABC or a simple ABC corrective pattern, but it's a complex correction. Does this void our outlook that the January 20th low should be taken out before the January 19th high is taken out? No, it doesn't. All it says is this is a complex corrective pattern. Nonetheless, it's still a corrective pattern, and this January 20th low should be taken out before the January 19th high is taken out. Let's go ahead and see what happens. And there it is, taken out and taken out once again as anticipated. Okay, this is US dollar Japanese yen cross forex data, 60-minute. Before we move on, I'm going to ask you a few questions, and then you should pause the video and see if you can answer them, and then we'll go over them afterwards. First of all, January 23rd to February 3rd trading range. What kind of characteristics does this rally have? Decline off the February 3rd high. What kind of characteristics does this decline have? With this basic information, if you're a trader of the US dollar Japanese yen forex market at this time frame, what side of the market would you want to be in and why? Go ahead and pause the video and answer the questions. Okay, let's go over to the answers to the questions. The January 23rd to February 3rd rally has non-overlapping waves for the most part, impulsive characteristics of a trend, followed by a decline off the February 3rd high that has an overlapping wave pattern, characteristic of a counter trend or correction. We even have a potential A, B, C corrective decline complete. So what does this basic information tell us? It tells us that the trend direction of the higher degree time frame should be bullish. And if we trade the US dollar Japanese yen on a 60-minute time frame, we would be looking for long positions for a rally above the February 3rd high. Because since there's an impulsive rally up followed by a corrective decline down, the probability is the February 3rd high should be exceeded before the January 23rd low is taken out. Okay, let's go ahead and review what we have learned in Section 1. Let's go ahead and review what we learned in Section 1. Trends are usually impulsive, non-overlapping wave patterns, very often subdividing into 5 wave patterns. Counter trends or corrections usually unfold in 3 waves or overlapping multi-wave patterns. A correction following an impulsive rally should be followed by a rally to above the high of the impulsive rally. Traders should be oriented to the long side following a corrective decline. A correction following an impulsive decline should be followed by a decline to below the low of the impulsive decline. Traders should be oriented to the short side following a corrective rally. This is very simple, basic, but very powerful information. Let's go ahead and move to Section 2 and learn about the typical price and time targets for corrections. Okay, now that we have learned and seen examples of the typical characteristics of trends and countertrends, let's go ahead and look at the subject of Section 2, typical time and price targets for corrections. The typical price target, not only for ABC corrections but all corrections, is the 50 to 61.8% retracement zone of the previous trend. I'll explain this in more detail in the following examples. The typical time target, not only for ABC corrections but all corrections, is the 38.2% to 61.8% time retracement zone of the previous trend. So let's go ahead and look at some examples. Okay, let's go ahead and look at our first example, which is Australian dollar, US dollar cross 60-minute Forex data. And as you can see off this March 2nd high, the decline has impulsive characteristics, non-overlapping waves, characteristic of a trend, and we can even count off a 1, 2, 3, 4, 5 wave decline, which is characteristic of a trend. Off the March 10th low, we have overlapping waves, which is characteristic of a counter trend. As you can see, the March 15th high has completed in the typical price target for a corrective rally, which is the zone between the 50% retracement and 61.8% retracement of this previous March 2nd to March 10th decline. If you do not have software that calculates these retracements quickly, what you do is you take the range of the previous trend, multiply it by the certain ratio. For the 50% retracement, you multiply that number by 0.50. Then you add that number to the low of the trend. That'll give you this number right here, 0.7393. So let's go ahead and see if the March 15th high is actually the corrective high off this March 10th low. And there it was. The March 10th low is taken out, so the March 15th high is the actual corrective high. Let's now look and see where this corrective high completed time-wise. Here we have the 38.2% to 61.8% time retracement zone of the March 2nd to March 10th decline. This is the typical time target for a corrective rally, and as you can see, the March 15th high completed precisely in this time target. The time retracements are calculated just like the price retracements, except you take the range in time, the number of bars, rather than the range in price. Let's go ahead and look at another example. Okay, this is JPM, JP Morgan and Chase 60-minute data. Let's look at the rally off the January 20th low. It has impulsive characteristics, non-overlapping waves, characteristic of a trend. We can even probably count a 1, 2, 3, 4, 5 wave bullish trend, and the decline off the February 1st high has overlapping waves, characteristic of a counter trend or correction. Let's see where this February 7th low is relative to the typical price and time targets for a corrective decline. I'm going to put the typical price targets for a corrective decline first. The 50 to 61.8% retracement zone of the January 20th to February 1st rally. That's 39.05 to 38.77. And as we can see, the February 7th low tagged to the tick the 50% retracement. Let's go ahead and look at the time retracements.
Here we have the typical time retracement zone, the typical price target for a corrective decline, the 38.2% to 61.8% time retracement zone of the January 20th to February 1st rally. And as you can see, the February 7th low is within this time zone. See if the February 7th low, which is in the typical price and time targets for a corrective low, is in fact the completion of the corrective decline off the February 1st high. And there we have it. The February 1st high is taken out, signaling the February 7th low is in fact the completion of the corrective decline off the February 1st high. Let's go ahead and look at another example. So do all corrections complete in the typical price and time targets for corrections? No, they don't. As you can see in this example, which is Diamond's daily data, the Dow Jones ETF, there is a nice 5-wave impulsive rally off the February 7th low to the February 22nd high, followed by a decline with corrective characteristics off the February 22nd high and completed at the March 8th low. This corrective decline completed in the typical price target for a corrective decline, the 50 to 61.8% retracement zone of the February 7th to 22nd rally. However, it completed beyond the 61.8% time retracement, which is the maximum target for a typical corrective decline. This next example, Quadruple Q's NASDAQ ETF, shows an impulsive rally off the October 13th low to the December 6th high, followed by a corrective decline that ended January 3rd. This corrective low completed in the typical time target for a corrective low, the 38.2 to 61.8% time retracement zone of the previous trend, which is December 27th to January 10th, but it completed above the typical price target for a corrective low, the 50% to 61.8% price retracement zone of the October 13th to December 6th rally. While these last two examples showed corrective lows that did not complete in both the typical price and time targets for a corrective low, they were corrective lows nonetheless, followed by rallies above the highs of the previous trends. Okay, let's go ahead and review what we learned in Section 2. Very often, corrections complete within the 50% to 61.8% price retracement zone of the previous trend. This is what we call the typical price target for a correction. Very often, corrections complete within the 38.2% to 61.8% time retracement zone of the previous trend. This is the typical time target for a correction. While not all corrections complete in both the typical time and price targets for a correction, enough do to keep aware of these targets and to use them effectively in trading ABC corrections. Okay, let's go ahead and go to Section 3 and learn about the typical price and time targets for wave C of an ABC correction. In Section 2, we learned about the typical price and time targets for the completion of an ABC correction. What we're going to do in Section 3 is narrow down these targets by looking at the price and time targets a wave C of an ABC correction typically ends. Let's start with the typical wave C price target. Wave C often completes around the 100% alternate price projection of wave A. And on the next slide, I have an example which I will explain in detail what the alternate price projection is. The typical wave C price target is the zone between the 100% alternate price projection and either the 50% retracement or the 61.8% retracement of the previous trend. Let's go ahead and look at the example on the next slide so I can explain this in more detail. We have another gold continuous daily example up. This is actually one of those smaller bull trends from the gold example from section 1, zoomed in. It's the August 30th to October 12th rally. And as you can see, the rally has impulsive characteristics, and the decline off the October 12th high has a potential A and wave B complete of an A, B, C corrective decline. Let's go ahead and throw up the typical price targets for a corrective decline. That's the 50% to 61.8% retracement zone of this August 30th to October 12th rally. I'm going to now take the 100% alternate price projection of wave A, which is the typical wave C price target. You take the length of wave A projected from the top of wave B, which is at 457.5. I'm going to repeat that. You take the length of wave A projected from the top of wave B, also known as the alternate price projection. As you can see, it's right above the 50% retracement. So I'm going to delete the 61.8% retracement, and we have our typical wave C price zone. It includes the 100% alternate price projection of wave A and the 50% retracement of the August 30th to October 12th rally, and it falls at 457.5 to 454.6. Let's now talk about the typical wave C time target. Wave C often completes around the 100% alternate time projection of wave A. The alternate time projection is just like the alternate price projection, but we're measuring time. The typical wave C time target is the zone between the 100% alternate time projection and either the 38.2% time retracement or the 61.8% time retracement of the previous trend. Now put in the typical time target for a corrective decline. The 38.2% to 61.8% time retracement zone of the August 30th to October 12th rally. Now I'm going to put in the 100% alternate price projection of wave A, projected from the top of, or the beginning of wave B, which is the typical wave C time target. Once again, I took the length in time of wave A, projected it from the beginning of wave B, and that gave me the 100% alternate time projection. This is closer to the 61.8% time retracement than it is to the 38.2% time retracement. So I'm going to delete the 38.2% time retracement. And we now have our typical wave C time target. And as you can see, the November 4th low tagged both the typical wave C price and time targets. It hit the typical wave C price target, 457.5 to 454.6, which includes the 100% alternate price projection of the wave A decline and the 50% price retracement of the August 30th to October 12th rally. And the November 4th low also tagged the typical wave C time target, November 4th through November 8th, which includes the 100% alternate time projection of wave A and the 61.8% time retracement of the August 30th to October 12th rally. Let's go ahead and add some bars and see what happened. And there we go. Gold took out the October 12th high. Okay, let's look at another example. This is Apple Computers AAPL 60-minute data. You see off the March 2nd high down to the March 6th low, we have a nice 1, 2, 3, 4, 5 wave impulsive decline. Ideally, an ABC corrective rally will unfold that we can consider for a trade strategy. We have a potential wave A high and a wave B low. So from this data right here, let's go ahead and see what the typical wave C price and time targets are. We start by looking at the typical price target for a corrective rally. That's the 50% to 61.8% retracement zone of this March 2nd to March 6th decline. And let's go ahead and look at the alternate price projection of wave A, which is the typical wave C price target. There we have it. 100% alternate price projection is 67.04. That's closer to the 50% retracement than it is to the 61.8% retracement. So we're going to delete the 61.8% retracement, and we have our typical wave C target. Now let's look at the typical wave C time target. We start with the typical time target for a corrective rally. That's the 38.2% to 61.8% time retracement zone of the March 2nd to March 6th decline, which is March 7th through March 8th. Then we look at the 100% alternate time projection of the wave A rally, which is March 7th. The 100% alternate time projection is closer to the 61.8% time retracement, so we're going to delete the 38.2% time retracement, and we have our typical wave C time and price targets. Typical wave C price target is 67.46 to 67.04, which includes the 50% retracement of the March 2nd to March 6th decline, and the 100% alternate price projection of the wave A rally. The typical wave C time target is March 7th to March 8th, which includes the 100% alternate time projection of wave A and the 61.8% time retracement of the March 2nd to March 6th decline. And as you can see, the March 8th high tagged this time and price target, followed by a decline below the March 6th low, signaling March 8th was the wave C and the completion of the ABC corrective rally. Okay, let's go ahead and review what we learned in section 3. The price and time targets for an ABC correction can be narrowed down by looking at the typical time and price targets of wave C of that ABC correction. Wave C of an ideal ABC correction very often completes at or near the 100% alternate price projection of wave A. In other words, wave C is usually near the same length in price of wave A. The typical wave C price target zone of an ideal ABC correction is the zone between the 100% alternate price projection of wave A and the closer of either the 50% retracement or the 61.8% retracement of the previous trend. The same goes for time. The typical wave C time target zone of an ideal ABC correction is the zone between the 100% alternate time projection of wave A and the closer of either the 38.2% time retracement or the 61.8% time retracement of the previous trend. Wave C usually takes around the same amount of time to complete as wave A did. Okay, let's go ahead and move on to section 4. We'll put a couple more of the pieces of the puzzle together, and then we'll look at some specific trade entry strategies. Okay, welcome to section 4, Wave C confirmation and a basic trade strategy. What we're going to learn in this section is what confirms the wave C of an ABC correction is complete, And the same confirmation is what confirms the actual ABC correction is complete. If in fact an ABC corrective decline is unfolding, a rally above the wave B high confirms the wave C low, and it also confirms the completion of the ABC corrective low. Same thing for the other direction. If in fact an ABC corrective rally is unfolding, a decline below the wave B low confirms the wave C high and the completion of the ABC corrective high. This will all become clear following the example on the next slide. Okay, here we have an Australian dollar, US dollar, cross Forex daily chart. Off the October 4th high, we have a 1, 2, 3, 4, 5 wave impulsive decline to the October 19th low. Then we have a potential wave A and a wave B of an ABC corrective rally. We're going to talk about the confirmation signal that the wave C high is complete. But before we do that, what confirms that the wave B low is complete? By answering this question, it'll help us answer what the confirmation signal the wave C high is complete. What confirms the wave B low was the rally above the October 21st wave A high. So what's going to confirm the wave C high and the completion of the ABC corrective rally? A decline below the October 24th wave B low. There we have it. This confirms October 27th is the wave C high and the completion of the ABC corrective rally to the October 4th to October 19th impulsive decline. Okay, we have the gold example up from section 3. If you recall, the November 4th low was in the typical price target for a wave C at 457.5 to 454.6. The 100% alternate price projection of wave A and the 50% retracement of the August 30th to October 12th impulsive rally. And it was also in the typical wave C time target, November 4th through November 8th, which includes the 100% alternate time projection of wave A and the 61.8% time retracement of the August 30th to October 12th rally. All conditions are lined up for our trade entry strategy. So what we're going to do is we're going to set a buy stop to enter a long position one tick above the October 27th wave B high. That's at 475.6. If the long trade is triggered, we'll place a protective buy stop one tick below the November 4th low, which would be at 456.0. Let's go ahead and see what happens. Long trade is triggered. Place protective sell stop at 456.0, one tick below the November 4th wave C low, and gold continued to rally. Now we have all of our criteria for an objective trade entry strategy. Following an ABC corrective decline into the typical wave C price and time targets, enter a long trade one tick above the wave B high. Why would we enter a long trade one tick above the wave B high? Because this is what confirms that the wave C low and the ABC corrective decline are complete. Place the protective sell stop one tick below the wave C low. A trade below the wave C low after the long trade is triggered voids the ABC correction, and this is a good place to put our protective sell stop. cancel the trade if the wave C low is taken out before the trade is triggered. The words in the parentheses are for corrective rallies instead of a corrective decline. And you're going to take a short position instead of a long position. Let's look at an example of this trade entry strategy in the next slide. Okay, let's go ahead and look at the Apple example that was in section 3. If you recall, the March 8th high tagged both the typical wave C price and time targets. So that means all criteria has been fulfilled for a short trade setup. We place a sell stop one tick below the wave B low to go short at 65.06. If the short trade is triggered, we're going to place a protective buy stop one tick above the March 8th potential wave C high. That would be at 67.21. As we already know, the short trade was triggered. And the protective buy stop is set at 67.21. Let's go ahead and review what we learned in section 4. A rally above the wave B high confirms the wave C low of an ABC corrected decline. Therefore, it's an objective entry place for a long position. The same thing goes for a decline below a wave B low of a corrective rally. A decline below the wave C low voids the ABC corrective decline, signals a complex or other correction should be unfolding. Therefore, it's an objective place for stop-loss placement. The definition for an ideal trade strategy is that it must have an objective entry price and an objective stop-loss price. The trade strategy demonstrated in this section has both these criteria. So let's go ahead and go to section 5 and learn how we can cut down some capital exposure with some trade strategies. Okay, welcome to section 5, adding an oscillator and the trailing one-bar entry strategy. In section 4, we learned an objective entry strategy that contained an objective price to enter a trade and an objective price for stop-loss placement. This is the definition of an ideal trade setup. What we're going to do here in section 5 is learn a method in order to reduce capital exposure for a trade. And then we're going to learn another objective trade strategy. Using an oscillator that correlates well with the market you are looking at can put you in a trade earlier, resulting in reduced capital exposure. And if you combine this with a trailing one-bar entry strategy, capital exposure can be reduced even more, which reduces overall risk or allows more shares or contracts or lots to be purchased. Let's go ahead and look at an example to see the criteria of an oscillator we can use. Okay, let's go back to the gold example we've been looking at in the last couple of sections. As you recall, we have a potential ABC corrected decline unfolding off this October 12th high. We have the typical wave C time and price targets. And if you look below, we have an oscillator. This is the DT oscillator. It's a proprietary oscillator that comes with the Dynamic Trader software. The DT oscillator is a stochastic RSI. If you do not own the DT software, you can use any oscillator of your choosing. You can use a stochastic, an RSI, a MACD, as long as the highs and lows, or the bearish and bullish reversals of the oscillator you use, correlate well with the highs and the lows of the market you're looking at. While no oscillator is perfect, you can see this oscillator and the oscillator setting that I'm using, for the most part, correlates well with the highs and the lows of the market. The bearish and bullish reversals of the oscillator correlate well with the pivot, highs, and lows of gold. What I mean by bearish and bullish reversals, When the fast blue line crosses below the slow pink line, that is a bearish reversal in this oscillator. When the fast line crosses above the slow pink line, that's a bullish reversal. You should know what a bearish and bullish reversal is with the oscillator you use. The bearish and bullish reversals of the oscillator correlate well with the highs and the lows of the market you're looking at. Then the next oscillator bullish reversal should coincide with the wave C low. Let me go ahead and add a bar to the chart. And here we have our November 4th low, if you recall. Tag the typical wave C time and price targets, and we have an oscillator bullish reversal. How do I know that this is a bullish reversal? If you can see, the moving average 1, which is the blue fast line, is higher than the slow pink line, meaning following this bar, following the completion of this bar, we had an oscillator bullish reversal. So before we move on, let's go over criteria of a new trade strategy. The trailing one bar high entry strategy. This is a long trade entry strategy. For short trades, just use the trailing one bar low instead of the one bar high. Here's the criteria for this trade strategy. It's just like the trade strategy in section 4, but we're just adding an oscillator. Following an ABC corrective decline into the typical wave C price and time targets, and following an oscillator bullish reversal, enter a trailing one bar high buy stop to enter a long position. I will explain the trailing one bar high buy stop in the following example. Place a protective sell stop one tick below the wave C low. Cancel the trade if the wave C low is taken out before the trade is triggered, or if the oscillator makes a bearish reversal before the long trade is triggered. Let's go ahead and go back to the gold example. Okay, November 4th low is in the typical wave C price and time targets, and we have an oscillator bullish reversal. All criteria is fulfilled for our trade entry strategy. We're going to place a trailing one bar high buy stop to enter a long position. The completed bar of the oscillator bullish reversal is the November 4th bar. So we're going to place a buy stop to go long one tick above this bar at 465.8. Now comes the trailing one bar high part. If this trade is not triggered, if that high is not taken out following the completion of the next bar, we're going to adjust the protective buy stop, the buy stop to enter the long position one tick above the current bar. So you'll see what I mean in a second. We add a bar. The long trade was not triggered. The wave C low has not been taken out. Let me go ahead and label this as the wave C low with the question mark, because at this point we wouldn't be positive that this is the wave C low because the wave B high has not been taken out. So since the wave C low has not been taken out, the oscillator is still bullish. We're going to trail this buy stop and put it one tick above the high of the current bar. It's now at 460.7. Add a bar. Now the long trade was triggered. Let me take these off. Protective sell stop. Place one tick below the wave C low, or the potential wave C low, which is at 456.0. And look at this capital exposure. A lot smaller compared to the trade strategy in section 4, where we entered above the wave B high. Let's look at our Apple 60-minute example again. As you can see, the oscillator settings that we're using here, the bearish and bullish reversals correlate relatively well with at least the recent highs and lows of Apple. As you recall, the March 8th high reached the typical wave C price and time targets, but we have not had a 60-minute DT oscillator bearish reversal yet. Let's go ahead and add a bar and see what we get. There we have our bearish reversal. We'd set a sell stop. It's a trailing 1 bar low sell stop to enter a short position. If the short trade is triggered, we'll place a protective buy stop 1 tick above this March 8th high. If the March 8th high is exceeded without the short trade being triggered, or if the 60-minute DT oscillator makes a bullish reversal without the short trade being triggered, we're going to cancel the trade altogether. And you see the short trade has not been triggered yet. It's a trailing sell stop to go short, so we adjust it to the 1 tick below the low of the current bar, now at 65.57, and let's add another bar. Once again, it was not triggered. The 60-minute DT oscillator is still bearish. Sell stop to enter the short position is now at 65.85. And here we go. Short trade is triggered. Protective buy stop placed. As we know, the March 6th low was taken out. This is the trailing 1 bar low trade entry strategy for short positions, for short trades. Let's go ahead and walk through one last example. This is NASDAQ E-mini 5-minute data. Off this March 9th high, we have a decline with impulsive characteristics, non-overlapping waves, characteristic of a trend. Off this March 9th low, we have a potential A and a potential B complete of an ABC corrective rally. Why do we have a potential wave B complete? Because we have a rally above the March 9th wave A high. Now we have enough information to put up our typical wave C price and time targets. Let's start with the time targets. The 50 to 61.8% retracement zone of the March 9th decline is the typical price target for a corrective rally. The 100% alternate price rejection of wave A from the wave B low is the typical wave C price target. The 100% alternate price rejection is closer to the 50% retracement, so we'll take off the 61.8% retracement. Let's look at the time targets now. 38.2 to 61.8% time retracement zone of the March 9th decline is the typical time target for a corrective rally. Now let's put up the alternate time projection of wave A from the wave B low. It's closer to the 61.8% time retracement, so we're going to take off the 38.2% time retracement. Now we have our typical wave C price and time targets. Actually, the typical wave C price target has been reached, but we haven't reached the typical wave C time target, and we also need a 60-minute DT oscillator bearish reversal in order to consider a trailing 1 bar low short trade entry strategy. Let's go ahead and add some bars. Look at this. Now we have a high that's in both the typical wave C price and time targets, and there has been a 60-minute DT oscillator bearish reversal. All criteria lined up for a short trade entry strategy. Okay, I'm going to go ahead and label that high a C but with a question mark, because it hasn't taken out the wave B low confirming the wave C high. I'm also going to take off the alternate price projection to clear things up. And we set a sell stop to go short, a trailing 1 bar low sell stop to go short, 1 tick below the current bar's low at 1657.0. Let's go ahead, and if the short trade is triggered, we place the protective buy stop 1 tick above the wave C high at 1660.0. Add a bar, and the short trade was triggered. On the next bar, protective buy stop is placed. Go ahead and add some more bars and see what ultimately happened. And March 9th, low was taken out as anticipated. Okay, this is the end of section 5, the final section of part 1 of the art of trading a correction. Let's go ahead and look at a review of what we learned in part 1 of the art of trading a correction. Okay, let's go ahead and have a general review of what we learned in the art of trading a correction, part 1, ABC corrections. Learning how to enter a trade following the completion of a correction can put you in a position in the direction of the main trend. It can have a very profitable result. While ideal ABC corrections do not unfold as often as other types of corrections, when they do unfold, when and where they end is very predictable. When wave C of an ABC correction completes in the typical price and time targets for a wave C, it is a very high probability trade setup. Entering a long trade following the rally above a wave B high of an ABC correction and placing the protective sell stop below the wave C low is an objective trade entry strategy with reasonable capital exposure. This goes for the same as entering a short trade following a decline below a wave B low. Using an oscillator and a trailing 1 bar entry trade strategy can get you in the trade earlier and will often result in a position with reduced capital exposure. With reduced capital exposure, you can purchase more more shares, more lots or more contracts, or you can just have a trade with reduced risk. So let's go ahead and look at a preview of what we're going to see in part 2 of the art of trading a correction. Okay, when you're ready to further your education on trading corrections, join me in part 2 of the art of trading a correction, using multiple time frames for trading corrections. In part 2, you will learn how each of the 3 waves of an ABC correction subdivide. This will narrow down the end of ABC price targets and help us enter positions in a lower time frame with even lower capital exposure. And you will also learn to use an oscillator in a higher time frame in order to find even higher probability trade setups to enter positions in the direction of the main trend. Okay, that concludes all the sections of part 1 of the art of trading a correction. Once you feel like you have a good grasp on all the concepts that we learned, move on to section 2, trading corrections using multiple time frames and with multiple units.